His primary responsibilities include covering the Kansas-Oklahoma fed cattle market and working with corporate partners providing information and analysis to help them make profitable management and marketing decisions. Kevin has worked with many agricultural companies and helping them understand the changes taking place in the commodities industry with emphasis in animal proteins and in particular the beef industry. Help me welcome Kevin.
Thank you. Thank you. It's good to be with you this morning. It's good to be with you. What we've got planned for the next hour, hour and 15 minutes is basically an overview of where the cattle market, in our opinion, is and where we think we're heading. We're going to spend time talking about supply, demand. Obviously, we're going to have to spend quite a bit of time talking about trade, African swine fever. We're going to talk about the plant fire up in Garden City and what that meant to the market this late summer and fall, and the progress that we think will take place as that reopens. And with this size of group, we'll just take questions as we go along. And then I'll open it up to questions at the end. And then I'll be around for, afterwards through the late morning. If you want to corner me with some individual questions, I'm open for that as well. So with that, let's just roll up our sleeves and get started. Let's first recognize that we've been in an expansion cycle for the last 6 years. This is the 6th year. We're going to talk about that. We do think that the expansion cycle is coming to an end. Not that we're going to go and liquidate anytime soon, but we do feel like that this is probably the last year that we'll see expansion of any magnitude. And of course, as we think about expansion, what drives expansion? Well, profitability, doesn't it? And in this illustration, we're just looking at different layers or different segments of the businesses. And over the last 30 years, have they been profitable or not? And you can see on the right-hand side, the bigger oblong circle, you can see there that we've had better demand and more profitability more of the time in more segments. If we go back and look at it pre-really 1998, and we reference that as a time frame, if we think about beef demand in the United States, it was in a downhill slide in the 70s, 80s, and through mid-90s. And if you start looking at the data as far as how many dollars have came back into our industry, really from 1998 on is a time frame where we've seen an uplift in beef demand domestically. And that's meant that more segments of our business have been more profitable a higher percentage of the time. So as we think about what drives profitability, we think about the cow business. What's it take? Well, the formula is you've got to have grass, don't you? You've got to have roughage. You've got to have Mother Nature that's smiling. And you've also got to have cash. The market has to be favorable. You have to have a little bit of incentive as far as profitability. So you put those two together and you have an expanding herd. And that's generally what we've had over the last 5 to 6 years. Now we'll talk about over the next couple of illustrations what we think will take place as we go forward through this year and the next couple of years that might suggest that it won't be quite as easy sledding as we think about it from a cycle and a supply standpoint as we've had the last couple of years. With that said, let's talk about weather. Dr. Art Douglas does our forecasting. He has for the last 40 years. And so we're going to talk about first where we sit today, and then I'll give you his latest forecast for winter and spring as we think about the U.S. In this particular illustration, we know that in your particular area, Southern Plains and on into the southeast, we've gotten drier over the last 3 to 4 months. And this would be a good illustration where we've seen more of the yellows and some of the reds creeping up. At the same time, we know that the last few days and last week, in particular, as we think about here in Texas, East Texas on into the southeast, we've had some pretty good moisture. So we've had a little bit of a change short term. Hopefully that will continue. But with that said, Dr. Art, and I'll be honest with you, he's been spot on. He's been extremely good over the last couple of decades, as far as from a forecaster standpoint. But his forecast for the coming summer, or this coming winter and spring, he's waffled on it quite a bit. And of course he goes back and he looks at analog years, and he's only found a couple of years. You think about it, we've gone from an El Nino pattern over the last couple years. He believes we're transitioning into a La Nina. And with that said, he goes back and looks at analog years, and he can only find a few, so his confidence level isn't as high as it's been over the last couple of decades. So with that, his forecast is for dry and warm situation to occur primarily in the southern third of the U.S. In this illustration, we're looking at Dec, Jan, and Feb, the winter months. And you can see on the left-hand side is the temp, and the redder the hotter. And on the right-hand side is precip, and again, drier than normal, with, as you get into the southeast, maybe more of a normal winter from a precip standpoint into the southeast. So that's Dec, Jan, Feb. Generally warm, generally dry, especially as we think about the central and southern plains. And of course, obvious as we think about this year's calf crop, when we think about calf demand, recognize the wheat country, the wheat pasture is a big spot for demand for calves. And as we talk about the calf market here in a little bit, that's one of the things we'd be concerned about, is just a little bit of a lack of demand for a couple of reasons that are holding these calf prices down a little farther than they really should be. And we'll talk about the relationship between calves, yearlings, and fats. And the calf market's a little bit cheap compared to the other two classes of cattle. This is moving on to the spring. This is March, April, May. And again, you can see that same situation, pretty dry and pretty warm. You know, some of the spots in the southeast may be a little bit of mixed. Up in Kentucky and Tennessee, looks like a good moisture in that cow country. But generally speaking, he would be a little bit concerned as far as the weather pattern as we go into late year and on into next year. And so with that said, and we start thinking about where the cows are located in the United States, this is one of the reasons, not only calf market that's came down, but a weather pattern that's starting to shift that is influencing our idea as far as what the cow herd will look like over the next year or two. We're going to suggest it's starting to plateau. But there's some factors that we look at that also suggest that's the case, and we'll look at cow slaughter and heifer replacements here in a minute. Input cost, we're going to use corn as a proxy here. And think about what the corn market this year, it's been volatile, hasn't it? You know, we've lost the crop, we've made the crop, we've lost the crop, back and forth. In reality, we're going to end up the year just averaging 15, 20 cents higher than we did the year prior. And you can see as we go into 2020, we still think not only U.S. has ample supplies, but also globally, the stocks-to-use ratio, or the amount of grain on the global market, is still historically pretty big. And so we feel like the corn market, even though it's ratcheted up here, you know, it's up close to $4 if we look at the Ds, and we think it can stay a little bit elevated as we go through harvest. We do think the USDA is probably overestimating both the acreage that will be harvested as well as the yield. But that said, we still think the stocks to use is going to be adequate as we go into 2020. We like the forecast for 2020 as far as planning, just looking at that weather forecast, that we do feel like as we go forward, we're more range bound from a corn standpoint. That said, I'll just throw maybe a little bit of a monkey wrench in there for those that follow commodities and commodity trading and money flow in and out of commodities. And we'll talk about more of this as we talk about the cattle. But recognize the outside money, the funds, index funds or commodity funds in general, have a little bit bigger influence today than they've had in the past. They make up a higher percentage of the trade or the open interest. With that said, the corn funds, the outside money, they are generally still on the short side. They still have to buy their way out of their position, which could mean that the corn market has a little bit more push or upside potential as we go through the winter on into the spring than just looking at the raw data would suggest. Calf values. Think about where we're at today compared to the last couple years. If we looked at the last couple years in particular, if you think about the fall run in 17 and 18, we really didn't have a dip, did we? You know, both of these years we didn't dip. U.S. prices stayed 165 or better. generally all the way through the fall. This year we've had more of a seasonal pattern, haven't we? Well, seasonal pattern, yes, but there's been a couple dips. You look at the first dip there around 4th of July, plus or minus. That's when corn market, the D's corn went to what, about 440, 450? We lost the corn market, calves went down. Corn, we made the crop, or looked like we're going to make the crop, calves came back. What about this spike right here? What was that? That was that plant fire up in Garden City, wasn't it? You know, a huge drawdown in the calf market, and fed market, and feeder market. I would just suggest that the price pattern we're at today, or the price levels today, are basically a year earlier than they would have happened if that fire wouldn't have had taken place. In other words, the calf market, yearling market, the fed market, all would have stayed more elevated through this fall. But that basically sped this cycle up about 1 year. And we've got a bigger supply, and prices were going to trend lower. We just got there, in my opinion, about a year earlier than we would have because of that event. So with that said, we look at where we're at, plus or minus $1.50, 55, and this is U.S. average. We would suggest on average, and again, that's average, that's kind of a break-even level for a lot of cow-calf producers. And with that said, that's also a little bit less incentive as we think about expansion as we go forward over the next couple of years. So we rolled together a weather pattern that's changing, a calf market that has came back down, and then we say, what's the data look like looking at the females? This is looking at heifers, percentage of heifers slaughtered as a percentage of total fed cattle. And obviously, if there's more heifers in the mix, that means you're probably keeping less of them back into the country to get bred back. 36 to 37 is kind of the magic mark as far as percentage. And you can see this year we're going to be solidly within that percentage. So that would suggest to us, on the heifer side at least, we're not expanding, but we're not contracting. Kind of an even spot there. If we look at the cow slaughter, in this illustration you can see the cow slaughter has bumped up the last couple of years, and you know, twofold there. One is we've just got a bigger cow herd. This last 18 months, at least until mid-year, the dairy industry was liquidating, and so that added more of the slaughter. Now the dairy industry actually is in a profitable position. Looks like they will expand as we go through the end of this year on into 2020. And so, combination of more cows to go through, a little bit of dairy cow liquidation, and obviously it looks like that we probably are starting to slow, or in our opinion we think we are in the process of stopping expansion. With that said, just looking at beef cow numbers, and first to 2020, that basically is suggesting that we do feel like we expanded a little bit here, looking in the rear view mirror over this year. But we're going to suggest we plateau the herd. As we think about what's driven the expansion over the last really 5 to 6 years, higher prices, obviously, better moisture conditions, yes, but what's been a big driver behind the higher prices? In our opinion, it's been demand. Demand, both domestically and also increased exports or global. And so with that in mind, think about the cycle maybe being a little bit different than we've seen in past years. If we think about going back into the 70s and the 80s and the first part of the 90s, it was supply driven. The market over the last decade or so has been more demand driven. And with that being said, we feel more comfortable that we don't have to go through as big a dip as we go forward over the next 5 or 6 years. We're assuming right now, if demand stays strong, especially domestically, we probably see a situation here the next couple of years where the market or the supply might plateau more than liquidate. So I think that's good news as we think about our business and the dollars flowing in, and we'll talk about that a little later, that it is, from a demand standpoint, good news. We go back and look at really a cycle that typically is a 10-year cycle. You know, the last little blip up there is 05 and 06. In reality, cattle prices were strong enough really from 2010 on we should have been expanding. But we were in the midst of the drought, weren't we? And so that really stopped us. In fact, if we looked at some of the regional data, in this illustration going back to 2006, because that was the last mini cycle peak, and say, okay, where geographically have numbers declined and then came back and expanded or repopulated. And you can see the big answer is obviously the Southern Plains, led by Texas, the red line. That's where we saw the most liquidation. We've came back up the ladder as we've restocked, but that's still a spot that we're deficit compared to that 2006 last peak. And so where's the capacity? Where's the potential to expand if we were over the next few years? If you had the moisture and you had the prices, this would suggest that the Southern Plains and also the Southeast are the two areas that have not came back from a number standpoint to where we were in 2005 and 6. Contrast that to a couple of other lines. The yellow line is the Northern Plains, led by the Dakotas and Nebraska. You've got more mama cows there than we had back in 2006. And that little purple line is actually the Northeast, an area that we don't think much about as we think about the cow side of things. But at the same time, they've got 100,000 more mama cows than they would have had 06. So something's changed there too. Well, you could take the opposite of that. They've got less dairy cows up there. So they still got the forage and the roughage, but they've changed a little bit of that geographically, where they've got more beef cows and a little bit less dairy cows. So just give us an illustration from a geographical standpoint what's taken place. Now, with a bigger cow herd the last 5 to 6 years, obviously we've had bigger cattle slaughter, haven't we? And as we look at this year we're on pace to be up about 300,000 head. We'll probably be a tick shy of that, primarily because of what took place in Garden City. Next year, with what's in the pipeline, bigger calf crop this year, we've got a bigger feeder cattle and calf supply outside of feedlots. Think about prices as after the fire in August, September, prices went down, didn't they? So as a cattle producer, what do? We wait for higher prices. If we've got the feed, the cattle are outside, we tend to keep them outside of the feedlot longer. And so what we've seen in our data, the on-feed report came out yesterday for the 1st of October. On-feed numbers down 1% compared to a year ago. September placements were up 2%, but a year ago September placements were rather light, rather small, so it's not a big number. In October, our placements in our data are up 20+% here, and we're close to the end of the month. We've got a lot of those yearling type cattle because didn't like the price and had the feed that got carried from August to Sep and got placed in October. So as we think about the placement pattern, and that means the supply pattern as we go on into next year for fed cattle, let's recognize there's a correlation there as far as what we've done. Cycle standpoint that we'll have more beef production as we go through the next 12 months. We're looking at fed slaughter here from a monthly basis. Just, you can see the seasonality. We know that we typically harvest the most cattle plus or minus June. Available cattle, best demand of the year, combination. And then you can see that seasonally supplies get tighter through the end of the year. Seasonally your tightest supplies in the first quarter. The red bar there represents a 40-hour kill week. And we think about the challenges that we've had the last couple years. You think about how many more cattle we've harvested since the low in 2015. We all need to recognize from 2000 to 2015, as our supplies got tighter, the packing industry contracted. And so there's less shackle space. And now as we've gone back up the ladder from a supply standpoint, the packing industry really has not built any new packing plants. Yeah, they've added capacity in a couple spots. New cow plant up in Idaho, I recognize that. Double shifting down here on one cow plant, I recognize that. But any large additions, we haven't seen it. And so our challenge is, instead of, if we go back historically, a 5-year average or even before, you can see that seasonally, they had to kill some Saturdays in the middle of the summer, but other than that, they were killing 40s or less because the cattle weren't there. Now they have to be incentivized, and how are they incentivized? With profit. to harvest a lot of Saturdays. And that's a big challenge for the industry because that leverage component really has, as we think about prices, there's a lot of dollars coming into our industry. But a lot of dollars have been left at the packing side of things the last couple of years because of the leverage component. Now, as we think about where we're at going forward, the company statement from Tyson is that they will open their packing plant around the first of the year. If we think about since the fire, which is kind of, I believe it was August 9th, for the first 3 weeks after that, the rest of the industry and Tyson themselves stepped up, killed a lot of Saturdays. A lot of the two-way plants that could kill cows or fed cattle, killed more fed cattle. And we actually killed as many cattle that next 3 weeks as we would have killed with that plant open, fed cattle. Now, as we went through September and October, we started to lose some ground. Part of that is we think about you can't run those plants every Saturday. The employees won't show up the next Monday. They've got that challenge. And so they've got to give them downtime. You had an explosion at the Cargill plant at Dodge here a week ago. They lost a couple days. You had some challenges, electrical challenges at the Liberal plant for National. They lost some time. You know, we've got to think about those packing plants. A lot of them are old, and they haven't had any, because they're making money, they want to run them. And so they haven't had any downtime for maintenance for the last couple of years. And so they're being kind of held together with baling wire, so to speak, and it's starting to show. It's starting to show. And so we have, in our opinion, lost a little bit of ground over particularly the last 6 weeks or so, and we are starting to push a few cattle back as we think about that segment. But my message here is also that seasonally, our tighter supplies are out there in 2020 as we think about the first quarter. Think about the premiums and the futures, and we'll talk about this in a little more detail. We've got some huge premiums out there in Feb and April compared to the cash market. In fact, about 3 weeks ago, we had the biggest premium in April compared to the cash we've ever had in history. Now the cash market's starting to perform. You know, we're basically $10 off our lows, and it's interesting as we think about that. We'll talk about that in a little bit more detail, but we basically are back to where we were pre-fire if we think about the Fed market. So my message here is a lot of cattle to come at us, but we're over the hump. From a seasonal standpoint, we go into tighter supplies from here on to the first quarter of next year. Carcass weights, we just need to recognize the long-term trend. It's productivity. You know, we're paid on pounds, so what are we going to do? We're going to make them bigger, aren't we? That's what we're paid on. This year, weights were down a little bit, primarily because of the tough winter we had last year in the central and northern plains. We'll talk about trade here. We'll start with beef, and then we're going to talk about it with our competitive meats because it really is, in our opinion, a big factor as we go into next year with African swine fever looming the way it is. So from a long-term perspective, we're looking at imports and exports. Right off the bat, you can see that the blue, we've got exports down 2% this year. We'll talk about that in the next graph. That's disappointing compared to our forecast when we came into the first of the year. Imports, even this year, we thought they'd be down, but they've stayed a little bit bigger. And then you can see our forecast for 2020. In the box, I think this is a good reminder. We've been expanding, producing more product over the last 4 to 5 years, but if we contrasted 2018 to 2015, we produced 3.2 billion more pounds in 18 versus 15. But the balance of trade improvement took 40% of that off the market. So this market had gotten better and stayed better a little bit longer, partially to a large degree, because trade was beneficial. We were taking more product off the market each year and shipping it somewhere else. Now, as we think about the forecast going forward here, this is looking just monthly, year-to-date for this year. Again, we've been disappointed. We came into this year and we've had 3 years of double-digit growth. And so this year we came in and said, we'll see more growth. We had it up 6%. And about mid-year, we said, we got to reforecast. We came back and forecasted even because we just hadn't performed. Now we've got it down 2. What's been the challenges this year? There's been a couple. There have been trade issues. Trade, tweets, all those kind of things. We think about the areas that we've had some challenges. Japan's been below a year ago. Well, we finally have got a deal worked with Japan where the tariffs will be back and will be competitive on the same footing with Canada and Australia. And so we're optimistic as we go into 2020 that we'll regain some market share there, in particular because Australia, in our opinion, 2 years of massive liquidation, they won't produce as much next year, and they are got front door access to China. The other area we've been disappointed has been Hong Kong. China's clamped down on that gray market, partially with all the negotiations with trade deals going on. So we just haven't been able to push as much product into Hong Kong as we would have liked. Canada hasn't taken as much product. They're harvesting more cattle north of the border. So that's been a little bit of a disappointment from an export standpoint year to date. We're rather optimistic both to Japan and also as we talk about food inflation in China, we do feel like one way or the other we'll get more product into China as we go into 2020. Just an illustration to break down and talk about the Australian part of that, but also 90 lean coal cow prices, domestic demand. And so the top one's looking at 90 lean prices, and you can see that they've stayed elevated through late summer on in here to the fall cow run, haven't they? The green on the top. Much more than the last few years. Hamburger demand domestically is on fire, to say the least. It's stout at food service and at retail. We'll talk about advertising a little bit, but that's one item at retail that's gotten more ad space year to date than anything else has been hamburger. And so U.S. consumer has helped us out there. The bottom one is just all it is U.S. prices for 90s minus what it would cost to bring Australian 90s in delivered. And if it's below zero, and right now it's $25 difference, it's $25 a hundredweight more expensive for imported 90s than it is domestic, even though our 90s are on fire. So that means we'll bring in less imported product from that particular region of the world. We've already seen it from New Zealand year to date. We're starting to see it now from Australia. We think that trend continues. So in our opinion, that's supportive for coal cow prices, and also just as we think about the carcass cutout value and also cattle prices as we move into 2020, this particular component. If we rolled all the value of exports together, in this particular case we're looking at beef in the red, variety meats in the green, and hides in the blue. And hide values have been disappointing over the last couple years, haven't they? Just a comment. You think about, we will spend a little bit of time, but not a lot, on fake meat and plant-based proteins. But let's just think back at some of the other ag products that have had a challenge there. Think about our dairy friends. Almond what? Milk. Soy what? Milk. Think about the market share they've lost there. People will say it's somewhere between 10 and 15% market share they've lost because of that. Hide industry is another example. Synthetic leather. That's one of the challenges we've got with hide prices. Global demand for natural hides have gone down because back in 14 and 15, we were trying to charge $120, $130 a piece. They went somewhere else. They went to synthetic leathers, and they haven't came back to us. And so that's been a challenge for hide prices as we think about it. So as our industry moves forward with some of the challenges that we have from a fake meat, alternative protein-based burgers and things like that, let's recognize it can get into our pocketbook. And we need to be proactive as we go forward on that particular issue. Message is here, we're still getting a lot of dollars from the export market. This year, a little bit less beef. Hides have definitely hurt. The point I want to make here, though, it looks like it's trended higher, and it has. But if we go and say, what percentage of a fed steer heifer is it? It's about 20, 21%. Just recently, this last year or so, is the first time from a percentage standpoint it's gotten back to pre-BSE levels. It's a lot more dollars, but as far as percentage of the value of a steer or heifer, we're just getting back to pre-BSE levels. So again, a reminder of how important it is as far as market access and some of those issues as we move forward. We roll it together. Now we're just looking at per capita beef supplies. And again, per capita beef supplies, domestic production, add in imports, subtract exports, divide by population. Point is, we've been expanding pretty rapidly the last 5 years because of the balance of trade, because of population growth. Beef supplies are still rather friendly as we think about prices. We have not put that much more product on the domestic market during this cycle. Trade's helped us out, and obviously population growth works as well. So our message there when we talk about supply side for beef is the fact that we still have manageable supplies in our particular instance going over the next year or two. Let's roll in the conversation. Now we're going to go to African swine fever, trade, the other proteins, and also talk about pork, poultry, and roll it together with total supplies. From a big picture standpoint, this is production by country. The big red portion of that left bar is China's pork. That's 100 billion pounds, 20% of the global protein production. The Chinese government the first of the year said they had an 8% loss in their herd size. Last month they had that up to 41%. Every month they've just stair-stepped and admitted it's bigger and bigger deal. Most folks that are in tune to that are going to tell you it's 40, 50%, something like that. That's a huge number. That's 20% of the global production, and if you've lost half of that, that's 10%. That's a big gap. The question is, who fills the gap? Is it filled totally? Who fills the gap, and at what price? Well, we think about the exporters around the globe, and really, from a big picture standpoint, it's us and Brazil. We export half of the protein in the markets. But there's a couple other spots, and green is pork in this illustration. EU is sending a lot of pork into China. Canada, off and on, depending on what's taking place from a political standpoint. Brazil's getting a lot of pork into China. We are to some degree, but remember we've got tariffs still in place. We'll look at that in a minute. But just an illustration of who can supply product into that country. This is global meat prices from an index standpoint going back to 2000 at 100. And you can just see the spike and roll up on the way up. I find it interesting here as we think about it, the spike, we came back down. Now global protein prices are moving higher again. And over the last couple of months it's been more evident, and big part of that spike, in particular the blue for pork, has been from the Chinese prices. And so there is a draw there as far as getting more protein. This is just an illustration. Live hog prices in China is the red, ours is the blue, and the difference is the green. Their hogs are worth 4.5 times more than ours are. 4.5 times. You'd think we would be able to ship a lot of product there, wouldn't you? And we are starting to see that. There's some logistics problems. Obviously, there's trade issues. Okay. Also, think about this range. Our prices are still pretty darn low, aren't they? We just haven't seen much of an uplift. Hog prices domestically have been pretty flat. And a big part of that's because we still got a world of pork on the domestic market. We still have a pile of pork on the market. Are we getting some headwinds, or excuse me, some tailwinds? A little bit here. China, pork exports, they picked up tremendously here through the summer. We do think that we will export a lot more product, not only through the end of this year, but also through 2020. And we've got some pretty big increases scheduled as we go through next year in our outlook. But let's remind ourselves that with all the tariffs and trade negotiations over the last year and a half, we've gotten a smaller and smaller piece of the pie as far as exports into the Chinese market. This is just looking at the value of beef, pork, and broilers going into China over time. You can see the orange portion, we had 50+% market share really from 2000 to 2009, 10, in that kind of an area. And then since then, we've been kind of stagnant, and the rest of the world has provided more protein into China. So it's a huge opportunity, but until something's done from a trade negotiation standpoint, we still have some challenges in that particular area of the world. As we go over the next couple of illustrations, we're going to talk about domestic pork and poultry production. For illustrations on beef for next year, we think we're going to produce about 1.5%, 1.8% more beef next year. A few more cattle going through the system, a little bit heavier weights. As we look at their competition, we're going to suggest broiler production is going to be up close to 4% next year. Remember when I talked about beef packing plants? We haven't really added much capacity. In fact, it was the opposite from 2000 to 2015. If we talked about broilers, they're in the process of adding new plants the last 2 years, and again next year. They're adding about 7 to 8% more capacity in a 3-year span. If we talk about pork, between 2015 and 2019, they've added about 10% more capacity. Why? They've been profitable, but also when we look at exports, you can see that they've been able to export more product year after year from a trend standpoint. And so my message here is that we've got more production coming online as we talk about pork and poultry. Also make an illustration here. There's one spot on this graph where production was flat, 2008 to 2013. What happened during that time frame? Had $8 corn, didn't we? And remember, high corn affects chickens and hogs more than it does cattle from a price standpoint, because they're much more dependent on grain for their cost of production. So that's an area where, as we think about grain prices going forward, we've got them pretty much range bound. But from a long-term perspective, high corn hurts their profitability more than us. We roll in the export side of the equation, and you can see where growth has came from. It's been exports over the last 20 years. And you can see our forecasts are pretty optimistic because we're thinking into 2020, we've got pork exports up 15%. 15% increase in pork is roughly an additional 1 billion pounds. That's a big number. And from a logistics standpoint, there are some folks out there are talking about pork exports up 30% next year. Price relationship suggests, that might be possible. But the logistic part of that equation, just getting that much pork through the system is a big challenge. So in our illustration, we're going to suggest, you've got more pork being produced, but you're exporting more. Per capita pork supplies over the last really 40 to 50 years have been range bound between 48 and 52 pounds per capita. The exception was back in this time frame where production was plateaued. We had a spot in there where we had per capita supplies down around 45 to 47 pounds, and pork prices went sharply higher. Even if we were to export 15% more pork next year, per capita supplies would still be between 50 and 51 pounds. And so it's not back to those areas unless you could say that we're going to export 30 or 40% more. Then you could say we get down towards that bottom end of that range, and hog prices and pork prices would be substantially higher rather than being supported to slightly higher as we go into next year. The importance of trade, I think this illustrates that as we think about it. The total portion of the bar is what we produce. The blue portion is what we export. Over time, we're just exporting more and more product. This year, it's going to be about 11% of beef production, even though it's 20+% of value when you put the hides and the drop credits in. On pork, it's going to be close to 25% of production. Broilers, it's about 19% of production. So it's becoming more and more important, And also it means we're more and more vulnerable too, though, to any kind of trade issues or hiccups that we have out there. So the bottom line is, as we finish the supply side of the equation this morning, is even though we're optimistic that we'll export more beef, pork, and poultry next year, we're going to offset that with those bigger production increases, and that still leaves more per capita supplies on the market. Talked about beef, a little bit more, still very supportive, strong prices. We roll in pork and poultry, it's still a headwind in our opinion. Let's shift gears and talk about demand. This is just looking at per capita expenditures of the 3 different proteins, really going back to 98. Again, why 98 is our base? That's the year we feel like we turn beef demand around. The point we want to make here of the basically $120 billion dollar increase since 98, we've gotten over 50% of the share. We've gotten more dollars coming back into our industry than the other 2 competitions have together, even though they're producing more pounds. We've been able to see our prices increase at a faster rate. In fact, it's interesting, if you go back and go to 98 to where we're at today, inflation has averaged 2.1% increase a year, 2.1. Fed cattle prices have averaged 3.6% increase a year. Retail and wholesale prices on top of 4%. So we are one protein that has, from a total dollars coming into our system, whether those dollars are distributed, that's another question, but as far as over the last 20 years, our prices, or the dollars available, have kept up and exceeded the rate of inflation. We've got stronger demand. The dollars are there, it's just how we get them distributed. So that's an illustration as far as what's available. This is just looking at demand index, and our point here is it's still strong. Might be off the peak a little bit the way this is calculated, but it's still very strong from a historical standpoint, quantity times price and index for inflation. So let's think about domestic demand first. This is just, sometimes I call this my steak and hamburger slide. And we're looking at the S&Ps that are in the process of probably next week, hopefully putting in new highs. And then you look at the Consumer Comfort Index, and it's as high as it's been really since the turn of the century. And so both of them, as you think about demand for whether we're talking about hamburger, the average Joe, or we're talking about a high-end steak going to Ruth Chris, both of them are doing very well. Our economy is generating full employment. You finally got wages going up at or faster than the rate of inflation. There's just a lot of things that we have going from us from an economic standpoint, but then also our product, if we think about it the last 20 years, has improved tremendously as well in the quality and consistency categories. Find this interesting. And this is a slide we don't share very often, and when we put this together, one of the guys in the office did about 10 years ago and didn't know really what it meant other than beef is pretty darn good value, isn't it? Here we are, minutes worked for a U.S. consumer to pay for 1 pound of USDA choice beef. You got some folks, and I do, people that I run with that aren't directly in the ag circle, and they say, well, that beef's high at the grocery store. So wait a second. Let's put it in reality. You're working 10 to 12 minutes for a product that's better than it's ever been historically, and you're complaining about it. Our product is still very adequately valued when we look at it in these terms. I also find it interesting looking at that long-term trend, and where did we bottom? 98, didn't we? And as we think about price-wise, we've came back since then. So I think it's some interesting data to look at and think about as you go forward in here. We still are a good value in our opinion. We think about the retail market, and it's changed tremendously the last 4 or 5 years. And you think about it, every week or 2 or month, you hear about somebody buying somebody else. You hear about home delivery, meal in a box. Amazon, you're going to buy something, it's going to be on your doorstep within an hour or 2. You know, it's ever-ending as far as the competition there. And so the way we reach out to our consumers and the products that we have for our consumers, we need to recognize will change over time. And our consumers are changing, especially the millennial side of things. And as we go forward, they're going to have more and more influence, not only the way they do business, but they also more media, social media pressure that's going to tell us how we're going to do more of our business going forward. So my illustration here is, let's recognize there's a world of change. One of the things that we've seen, and this is looking at advertising, this is beef advertising, share of the pie, basically, beef, pork, and poultry rolled together, what percent beef makes up of advertising. Very good trend, isn't it? You know, we priced ourselves out of business, basically, from an advertising standpoint when we went to $1.73 fed cattle. You know, we recognized we got a cart in front of the horse there. Very strong trend since then. That's good news. Troubling news is this. Over the last, and it really has just been the last 12 months or so, we've seen less advertising for beef, pork, and poultry. We're still getting our bigger share of the pie, but that pie is shrinking. The retailer, for whatever reason, is featuring on the front page in particular something a little bit different. Whether that's seafood, whether that's produce, fruit and vegetables, other items, it's changing a little bit. There's changes going on there. Something that I think we need to recognize. We're still what they turn to get people into the store and spend dollars. But let's recognize there's a little bit of something's changing there compared to what we've had historically. From a restaurant standpoint, the message really is that all segments are doing good. The one segment that continues to be kind of a off and on is that casual dining. And again, if you ask a millennial or somebody younger, do they want to go to a Chili's or an Applebee's? You know, they have a preference for something else. It's typically a fast casual. Hamburger joints are doing extremely well. Fine dining is doing extremely well. We're kind of hitting on all cylinders, so to speak. Okay, I'm going to throw a couple slides in here. I threw them in to address. And here we're talking about cow business. We're talking about a cow-calf survey that we put together every year. This past year, it was about 1,400 people that we took a survey from. Accounted for about 600,000 mama cows. We do it every year. And really what we're trying to portray, there are some traits that high return producers follow year after year. We're going to suggest that the difference between a high return producer in the blue line, low return producer in the red line is huge. And so we're trying to determine what's the difference between those categories. Well, the things that come out time and time again, the high return producer is willing to pay more money for animal health, nutrition, and genetics. Why? Because they know it affects reproduction, fertility, weaning weights, marketability, and the marketing piece also fits in there. We find that those high return producers are more willing or more apt to retain ownership, do some things with that calf crop that some of the other folks won't do. With that said, we've built this a number of years, and over time the dollar values on the left-hand side change. But in reality, what we're looking at here is just, okay, are there stair steps to profitability if we're running a cow business? And I think the answer to that is yes. Some calves bring more, others don't. We all recognize that. What are some of those factors that add value to that calf crop? And I think we all need to be aware that this bar is heading north. It's getting higher every year because more people are doing this. And as more and more people do some of these items, some of these premiums will dissipate or become smaller. The bar becomes higher, and the discounts become larger. And so I think we need to recognize that as a long-term trend. Just looking at the ways, and these are logical, so we think about the high return producers, what happens? They have a higher percent calf crop. Obviously, they just do a better job all the way through from a management standpoint. So you can see from a trend, and this is the last 3 years of data, you can see that they have a higher percentage of calf crop. We can also see that live weights are heavier, so they got more calves to sell, and they're heavier. What are we selling? We're selling pounds. And so they do a better job from that reproductive efficiency standpoint. They've got more cattle at heavier weights. And also, this is just looking at the bull price, purchase price. And the way you'd read that is the left hand is those who paid $2,500 or less for a bull. The bull battery, that's about 25% of the respondents. Average calf value was 803. Big bar in the middle, about 55% of the respondents, they spent between $25,000 and $5,000 for a bull. 865. 5 to 7,500, 943. Over 7,500, 1062. So the correlation there, those that were willing or apt to spend more money, as a trend standpoint, that calf crop was more valuable. Weren't shorting themselves. In fact, they were willing to pay more for that bull battery because they knew what they're going to get from a genetic standpoint. Let's talk about the market as we go forward in here. Start with the fed side, and we'll roll to calves and yearlings. The spike down here, we recognize we probably got $4 or $5 deeper than we would have without that fire. My point is we're back to pre-fire levels. Go back the last few years, we've been kind of in a range, haven't we? $1.05 to $1.30, except for some outliers. You know, our opinion as we go into 2020, and we're in the process of finishing our outlook for next year, that we've got a long-term outlook session in Denver in December, and then of course the convention outlook in January. We're in the process, and we're going to suggest next year's market is probably going to be similar range, $1 at the bottom, $1.30 at the top. Spend a lot of time between $1.05 and $1.25. If we get to the top side of 30, that's probably an outlier. That's probably driven by something different. At the same time, if we have to go below $1, that's probably driven by something different here. This last year, or this past couple months, it was a fire. The point is the trend's higher as we go from here on into the spring of next year. Well, we put a low in it, let's say it's $1. For simple math, what's that mean the market can rally by the end of the year, in normal years, and also into the spring of next year? By the end of the year, this is just looking at the long-term average, the low into the fourth quarter high, seasonal years, which we're in, is a 14% rally. I understand there's a lot of variance around here. Let's just say the average. 14 from $1, that tells you $1.14 for a target by Christmas time. On into next spring. In this illustration, found the lows, what's the high the next spring or the first half of the next year. And in this particular data, we're dicing it one more time, and we're going to say in years only that we had more than a 20% drop like we did this year from first half high to second half low. So that's the blue bars. Take the blue bars, we throw out the extremes, comes to 23%. So from $1, that tells you 123 for an objective for next spring. Where did the April cattle close yesterday? At 123, didn't they? Very close. The market's anticipating, starting to build that in. Cattle on feed report came out yesterday, and I think it's really interesting, and it is affecting our market, that the winter that we had last year in Nebraska, Iowa, and the Dakotas, it's got a long tail. In fact, they've had 3 tough winters in a row in eastern Nebraska. Where are the cattle being placed right now? They're staying south, aren't they? They're staying where the weather's been better the last couple of years, even though we all know that they have a corn basis advantage. Their corn's cheaper. They got their butts kicked the last couple of years. And not only some of those producers up there, but also investors that were feeding up there says, no moss, I'm not feeding up there again. Not now. And so those cattle, as you can see, we've got more cattle on feed. Obviously Texas, Kansas, Colorado, less in Nebraska and Iowa. Now over time, will that ship come back and kind of right itself? It probably will. But again, that weather that they went through has had a long tail as far as where cattle have been placed. That's a big part of it. And also that's affected price. In this illustration, as we think about price, we can see that we've had a big discount in the South compared to the North. Because of why? Two reasons. One, we've got the cattle difference and also the plant fire. What happens at January 1 when the plant comes back online? You would assume that we'll get back more in a balance, but you still got a challenge here from an on-feed number as you go on into next year. A couple of things we'll just hit on here. This is looking at grade, and there's been some real challenges with grade over the last couple of months. Top left is prime. Grade's held together very well, but it's not year-over-year increases. Top two-thirds choice is the same. We've got a lot of cattle that were kind of in betweens. In other words, they're right here between the line, small zeros and slight 100. For whatever reason, we've got more cattle that are kind of fallen out of that the last couple of months. We're hauling cattle farther. We know that because of the plant fire. We know that we're putting wheat in the ration. Doesn't have as much energy as corn. There's probably a half a dozen different factors, but recognize that's taking place here short term. And because of that, we've had a huge choice select spread. And you can see that illustration on the bottom. The top is prime choice spread. Look how flat it was in 18 when we were producing a lot more prime. Well, what's happened here through the summer, even though we're producing a lot of prime, I would submit we're seeing a lot more prime being used, especially at retail. Costco is a good example. At retail and more demand for that particular product. So the message here is the spreads are probably going to stay a little bit wider as we go through the fall. You still got the holiday rib, Pismo to buy. Look for the spreads to stay very wide as we go through the fourth quarter.
How is the 44 deal with Walmart going to affect the rest of the market?
The question was with the 44 deal with Walmart. I think that's just an example of usage of prime. It will pull some of that prime product that would have been available, let's say, for somebody else. Maybe that product would have gone to a Costco, high-end restaurant, or go to a Costco. So it's more demand. More demand should increase price unless supply outstrips demand. So it's supportive for the spread and supportive for prime product. Short term, and now we're talking about the futures and where the market potential is as we go forward through the end of the year and first part of next year. The top is just an illustration that we've got fewer cattle hedged than we've had historically, at 37%. And that's it. We'd take that from open interest numbers. So less cattle are hedged. Why? Well, a lot of cattle have been upside down in here. There's the prices. Finally got the futures back above our projected break even. Now we're starting to see the cattle feeder become more hedged. And so the futures in here, it's been, in our opinion, a one-sided trade since the lows. Now it's going to become more of a two-sided trade. You've got a cattle feeder that's going to sell the market because he's going to hedge. And we've got, in our opinion, managed money that's going to buy the market because they still have a short position. They're blowing out of those short positions. Here's just looking at the February cattle, and they closed closer to 121 on Friday. Does it need a correction? Is it overbought? Absolutely it's overbought. It's been straight up for 15 bucks. Tried to correct for about 10 days, consolidated, now it's put new highs in. Trends higher. You set in there, you can see the technicians will tell you it went through those crosses there, moving average crosses, the trend's higher. It's got more go to it. Even though when we look at the supply and demand, we would say it's adequately priced for where we think the market's going to average in Jan and Feb. The money flow, there's enough fund money that has to come in yet. And this is the illustration. This is open interest. It's trending higher. That's the target in the red box. If you get to that target, the black box is the target next spring. Open interest increases. Highest correlation is managed money, long position, and open interest. Outside money, if they're stepping in and buying the market, open interest goes up, and typically the market goes with it. Who's going to sell the market? It's a cattle feeder, because he's going to have profit opportunities from here forward with the cattle that have been purchased really since the plant fire. Those cattle have an opportunity to be hedged at a profit. So you've got a two-sided market. Every time it sticks its head up, cattle feeder sells it. Every time it goes down, the funds buy it. Our message is it's getting into what we would say is a fundamental spot that's adequately priced. But even though that's the case, it probably has a little more potential on the upside. And here's just the look at the managed money. You can see the managed money was, here's a long side, extremely long earlier in the year, extremely short. Now they're starting to buy their way back up. So from a historical perspective, there should be more money on the sidelines to come in, is the message. Feeder market. Been disappointing, hasn't it? First circle, corn. When corn went to $4.40, $4.50. Saved the crop, feeders came back up. And oh no, got the fire. It went back down. Now they came back. In our opinion, the feeders are supported in here because of the back end of the fats, the Aprils, the Junes of next year. We feel like we'll stay where they're at, if not get better over the next 2 to 3 months. That should be supportive to the feeders and the feeder paper as we think about going through the end of the year. Calf market. Either your own calf crop or your customers. Think about the calf market. Talked about that earlier, that they were very depressed after the fire and they haven't came back. Feeders have came back. They basically came back close to where they were pre-fire. Fed markets came back, but the calf market's still depressed. Look at the relationship between a calf and a yearling, and it tells you the calf's undervalued. From a historical perspective, they're way undervalued. They're a good buy. They're also, if they're a good buy, that means if you own the calf, they're probably a pretty good investment to retain ownership and try to prolong that. To illustrate that, we just went back and looked at a 5.5 weight steer calf in October compared to a 8.5 weight yearling weight steer in March, and said what is the increase in value per head for that time frame, and what would that pay me from a cost to gain standpoint to put that 300 pounds on. And so you can see the last decade, it would have paid you about 94 cents a pound to add that 300 pounds. I went on Friday and said, okay, I looked at the 5.5 weight U.S. average, and then I looked at the spring feeders and put the appropriate basis, U.S. basis on for an 8.5 weight. It would suggest the futures market would pay us, or the market would pay us over $1 a pound to make that 5.5 weight an 8.5 weight. Calf market's undervalued compared to the yearlings. I think that's a message for either your calf crop or your customers, something to consider and think about. Say, wait a second, do you have the feed? Do we have the resources? Can we do something with that calf crop? Take them into next spring. The futures market are allowing us, if we want to hedge them, the opportunity to put that money in our pocket, and if we're not a hedger, the long-term odds favor retaining ownership with the calf market where it is today. Just an illustration that how many calves it takes to pay for a bred cow. Coming down from a cycle standpoint, the data would suggest the bred stock's probably just a little bit overpriced. I know you don't want to hear that, but that's I think the reality is the calf market comes down in here. The bred cow market has to come down too. Cow market, we're just about ready to wrap her up. This is looking at the seasonality of utility cows. Interesting, you look at 17, and you look at 18. I mean, we never sold cattle in 18, or cows better than 17. Then in 19, look where we've done late summer. Remember when I looked at that 90% trim graph? Looked the same, didn't it? 90 trims trading above a year ago, cull cows are. I obviously understand that cull cows are dirt cheap. And we understand that the relationship is the same in the cow market as it is in the fed market. We don't have enough shackle space to kill the cows. I mean, there's a waiting list to kill cows. I know that. And we also recognize that the fourth quarter, a big cow run, a lot of them are going to get pushed into the first quarter to find a home for them. And so they are still historically very low, but they're more well supported today than they've been the last year, year and a half because of what's taking place in the trim market. Just finish up and we'll go to Q&A, and again we can break and I'll be around, but just remember we're at within the cycle. And there's a lot of good news out there. We've got a better product than we've ever had in the past. Good economy, more dollars are coming in. The challenge is where those dollars are being distributed. I mean, there's the export markets, even though we've got a lot of headwinds, long term they're positive. More mouths to feed outside of the borders than inside. And we feel like that we'll continue to fulfill that. But short term, let's recognize we've expanded for 6 years. Pork and poultry are expanding. And from a cycle standpoint, you can see we've got fed prices. We might be a buck higher than that next year. You know, fed prices we think are going to be pretty well supported. But we're just in that segment or that phase of the cycle where prices do contract. And when they contract, it comes back to what you as a cow producer want to do. If you've got a commercial herd, are you stuck selling that calf, or can you retain? Can you participate in those other segments of the business where there might be a little bit more profit to be made? Just leave you with that. Any questions? I maybe have ran a little bit long, apologize for that, but any questions? I'll take them now, or I'll be around for the next hour or so if you want to hit me. Yes?
The fake meat issue has bothered me a lot. It's not just beef, it's chicken, not even fish, I think. But I know that the industry has pushed for proper labeling and some other regulations. But what is your best guess as to just how much in beef the various fake products, whether they be plant or stem cells, is going to adversely impact beef over the next 10 years?
Okay. Probably the best question, or the most challenging question that the industry faces, and one that none of us have probably a real good answer, but this is, I'll give you opinions. And if you break down the fake meat to the plant-based, and let's go with the stem cell first, the technology there, even though it's advancing very quickly, we feel like that's down the road a ways and probably will not step in and be as big a challenge as quickly. As we think about the plant-based, obviously we turn on your TV and now you got every burger chain in the world, not everyone, but a number of them advertising on prime time. Let's just take what the milk guys. You know, it went from a 0 share to about a 12, 13% share is what almond and soy milk took. Will that be the model for beef? I don't know, but I think we have to look at that gauge and say, there's more risk there than we might think about, well, they're only selling a quarter pound per capita today. There's more risk. And so I don't know the right answer other than to say we have to assume we're going to lose market share. Initially, a lot of that product's being consumed by people that probably wouldn't eat beef. But there's a lot of folks out there that are going in and trying it. And if they try it and it's somewhat similar, well, I can do this, and the social media tells me that I'm not hurting the planet. They don't care that it's not as good for them. Beef is a better product than that. There's more salt, there's more, there's more things in that are not good. They don't really care about that. They think they're saving the planet. So I don't have a good answer other than, as an industry, labeling is extremely important. One thing I frankly think that, and I might be just, I'm talking, but beyond meat, that tells us that what? They're beyond us. They're better than us. To me, it's slander. It's slander. And should there be legal action there? I don't know. You know, it's one of those deals where hopefully as an industry we're proactive enough to educate the public that what we have compared to what they're offering, it's different. We've got a better product. And so I'm not coming to any conclusions from your question, but those are just some ideas that I have. It is, in my opinion, going to be, let's say, a headwind, a depressant. I can't tell you if that's 50 cents or $5 or 100, you know, per hundredweight. I can't tell you that. But I do say we have to be, as an industry, pretty proactive because it is a challenge.
Do you see anything the industry can do other than what it's done about accurate labeling and so forth that will limit the success of these other products? Is there something that's going into the making of those things that we can say is bad from a health standpoint, or
That,
the continued use of it would be detrimental to health?
that's yeah, the continued education piece, I think, is real. I know there's been some people that have put some data together, and you put the three, what's the most common ingredients between an Impossible Burger and Beyond Meat and dog food? They all have about 70% or whatever of the ingredients are the same. And to your point, there is products in there that we don't know if they're detrimental, but they're sure not as wholesome or natural as a hamburger. And so to me that's continued education, being more proactive as an industry. Yes?
With Mexico in the process of building their big plant, what should we expect, or what can we expect from that on our side of the river?
You know, as a trend, I think we need to recognize, we can talk both north and south of the border, but if we're looking at Mexico, let's recognize that as a country, they would love to be more self-sufficient in animal protein production. And not only self-sufficient, they would like to be involved in exports, which they do export obviously to the U.S., but also to some Asian countries. They export some product too, beef and pork as well. So from a trend standpoint, you can see it in the data. This last year was a little bit odd, but for the last 6 to 7 years, as a trend, we've increased imports of beef from Mexico, and to a point where the last couple of years it's almost an even swap looking at live cat or on beef. So continuation of the trend. They're going to build more capacity south and try to produce more product not only for their market but for exports. Yes?
Will their quality of beef be as close to ours as
You know, from a genetic standpoint, their genetic pool would be different than the U.S., but it's becoming more and more influenced by U.S. genetics over time. So as if we want to look at averages, no. It would be, you know, the product would not be, in our opinion, and in the market's opinion, price-wise, is not as good a product. Over time, from a genetic standpoint, probably gets a little bit closer.
Kevin, you talked about the difference in leverage that packers have today over basically any other sector. How does that change, and when can that possibly change?
That's a question that's it's in everybody's mind as far as when can we get the lever back. I'll just submit an answer. The way we're kicking it around, the way we're going to answer that is from a cycle standpoint, we still have ample supplies of cattle the next 2-3 years, foreseeable future. To build a packing plant, let's say, that will harvest 2,000 to 4,000 head a day, let's say in the Fed side, we're looking at probably $300 to $500 million. And we're looking at 2 to 3 years time frame. And that's really one of the sticking blocks of why the industry hasn't done that. We're a secular business. By the time I invest my money, we'll be at the other end of that business in tighter supplies. What we see taking place is that with the plant fire in Holcomb, the industry learned they can kill more cattle than they thought. Now, they're running the plants hard and their workers hard, and they're going to have to kind of figure that out. But in our opinion, you'll see some smaller entities, your Creekstones of the world that are adding capacity, Tama adding a little bit through efficiencies. JBS is putting a lot of money in the Grand Island plant. They say they won't kill more cattle, but there's got to be some efficiency gains there. When Tyson opens up, more than likely they've done some tweaking there. They're going to be a little more efficient. And so, the plant out in Brawley, that's the same way. They can kill more cattle. They've got so many SKUs, so many different programs. There's enough plants out there that we think next year our capacity on a daily basis is going to be about 1,000 head bigger, just by some of those efficiencies and some of those plants doing what they are. I talked about an increase of 250 to 300,000 next year. That's what it is. That's 1,000 head a day, offsets that. Assuming you don't have a fire next year, assuming that they go ahead and start killing a few more Saturdays. And another thing to think about here is you've got a couple of these packers. All of them are driven by the same. We're all driven by the same thing. It's greed, making money in this particular illustration. They have somebody to answer to up the ladder. They've got stockholders. And they're sitting in here this year going to get used to making $200 a head. Next year, let's say they're only making 150. What do? They have to kill more cattle, don't they, to make the same amount of money. So let's not forget that piece of the equation. That we get to next year, right now we're thinking that leverage next year could be a tick better for the cattle feeder than it is this year. Because we think we've increased some capacity on a daily basis. We think there's going to be a little bit of greed factor on the packer side, and also some market share regaining. And we hopefully don't have to go through the disaster we had with the fire. So the leverage over the next couple of years, but we don't think it has to be any worse than it's been the last couple of years. We think they've learned enough efficiency gains that there's going to be a little more in the system to kill more cattle. Any other questions? Okay.
Packer own cattle. That's one more.
What's that?
The volume of the cattle that the packers own now that they're killing, how does that change the dynamic of the marketing system?
Think about what's happened the last couple of years. Packers making a tub of money. At the same time, what did Cargill do? They sold their feed yards. What did JBS do? Sold their feed yards. Why feed cattle? Why tie up my capital for 180 days and make $20 a head when I can own the product for 3 to 5 days or 10 days and make whatever that number might be? So you've seen, and I recognize you've got some packers that feed cattle and some of them that have vested interest in partnerships with cattle feeders, but there's less today than there's been historically, primarily because where we're at in the cycle. And the amount of capital that it takes to feed cattle. It's tied up. Yes?
You see any change in generational change as people move out of the baby boomers to the next generation of producers?
From a generational standpoint, yeah, absolutely. It's a huge challenge in our business, and that's one of the reasons that we talk about the herd size plateauing in here is that who wants to work this hard? You think about the next generation and put the hours in, and it's not only that, it's the cost of money or the cost of doing business to buy your way into it, regulation. There's just a lot of headwinds as far as doing it. So absolutely, it is a spot that we see limiting expansion. Okay, any other questions? If not, it's a pleasure to be with you again. I was with you 2 years ago in Galveston, and I appreciated the invite. Thank you.